The easiest way to start investing is not by finding the next big stock. It is not by copying a millionaire on social media. And it is definitely not by putting all your money into something you do not understand. The easiest way to start investing is much simpler than most people think. You start with one goal, one account, one simple investment, and one automatic habit. In this video, I will show you exactly how a complete beginner can start investing step by step, even if you only have a small amount of money. By the end of this video, you will know what to do first, where to put your money, what to avoid, and how to make investing feel simple instead of confusing. First, let's understand what investing actually means. Investing means using your money to buy something that can grow in value or pay you money over time. Instead of keeping every dollar in a savings account, you put some money into assets like stocks, bonds, or funds. The goal is simple. You want your money to work while you are sleeping, studying, working, or spending time with family. But before investing, there is one important rule. Do not invest money that you may need soon. If you need the money for rent, food, bills, school fees, emergencies, or debt payments, keep it safe. Investing is for money you can leave alone for years. Because the market goes up and down. Some months your investment may increase, other months it may fall. But when you invest for a long time, you give your money more time to recover and grow. So step 1 is to build a small emergency fund. You do not need to wait until you have $10,000. Even saving $500 to $1,000 can help you handle small emergencies without selling your investments. Once you have some emergency savings, you can start investing. Now, most beginners make investing too complicated. They start searching for the best stock. They watch videos about crypto. They see someone making money from trading. Then they feel like they need to learn everything before starting. But you do not need to know everything. You only need a simple system. The easiest system for most beginners is to invest in a low-cost index fund. An index fund is a fund that holds many companies at the same time. Instead of buying one company, you buy a small piece of hundreds or even thousands of companies. For example, an S&P 500 index fund invests in around 500 of the biggest companies in the United States. That means when you invest in one S&P 500 fund, you can own small pieces of companies like Apple, Microsoft, Amazon, Nvidia, Google, and many more. This is easier and safer than putting all your money into one stock. If one company has a bad year, it does not destroy your entire investment, because your money is spread across many businesses. This is called diversification, and diversification is one of the biggest reasons index funds are beginner-friendly. Now you may be thinking, how much money do I need to start? The answer is much less than you think. You can start with $10. You can start with $20. You can start with $50. The amount is not as important as the habit. A person who invests $50 every month for years can build more wealth than someone who waits for the perfect time but never starts. The biggest advantage you have is time. Let's say you invest $100 every month. That is about $3 per day. If you keep doing that for many years, your money has a chance to grow through compound interest. Compound interest means you earn returns on your original money, and then you earn returns on those returns too. At first, it may look slow. But over time, the growth can become much bigger. That is why starting early matters more than starting with a huge amount. So how do you actually begin? First, choose an investing platform. For beginners in the United States, people often use a brokerage account. A brokerage account is an account that allows you to buy investments like stocks, ETFs, and index funds. Many platforms allow you to open an account online. But before choosing one, look for a few simple things. Look for low fees. Look for easy-to-use investing tools. Look for the ability to buy index funds or ETFs. And make sure the platform is legitimate and regulated. You do not need fancy features. You do not need options trading. You do not need margin. You do not need to trade every day. You only need a simple account where you can invest consistently. Once your account is open, the next question is where should your money go? For a beginner, one simple choice can be a broad market index fund or ETF. An ETF is similar to an index fund, but it can be bought and sold like a stock. Examples include funds that track the S&P 500 or the total U.S. stock market. The exact fund you choose is less important than understanding what it does. You want something broad, you want something low cost, and you want something you can hold for a long time. Do not choose investments just because someone online says they will explode. Do not chase hype. Do not buy something because it went up last week. The market rewards patience more often than excitement. Now let's talk about one of the easiest ways to make investing automatic. Set up recurring investments. This means your investing platform automatically invests a fixed amount every week or every month. For example, you can set it to invest $25 every Friday, or $100 on the first day of every month. This is powerful because it removes emotion. You do not have to guess when the market is low. You do not have to wait for the perfect moment. You simply invest regularly. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this can help you build your investment without stressing about daily market movement. This strategy is often called dollar cost averaging. And for beginners, it is one of the easiest ways to stay consistent. Now, let's talk about retirement accounts. If you work in the United States, you may have access to a 401k through your job. A 401k is a retirement account where you can invest money from your paycheck. Some employers even match part of your contribution. For example, if you put in 5% of your paycheck, your employer may add extra money too. That is basically free money. If your employer offers a match, try to contribute enough to get the full match if you can. Because missing the match means leaving money on the table. Another option is a Roth IRA. A Roth IRA is an individual retirement account. You contribute money that has already been taxed. Then, if you follow the rules, your investment can grow and be withdrawn in retirement without paying taxes on the growth. For many beginners, a Roth IRA can be a great place to start. But remember, retirement accounts have rules and contribution limits. So always check the current rules before making decisions. You do not need to open every account at once. Start with one. If you have a 401k match, that may be your first priority. If you do not have one, a Roth IRA or regular brokerage account may be an option. The goal is not to create the perfect investing setup on day one. The goal is to start. Now, here are some things beginners should avoid. First, avoid day trading. Day trading looks exciting because people post screenshots of huge profits. But they usually do not show the losses. Trading requires skill, time, emotional control, and risk management. For most beginners, long-term investing is much easier and less stressful. Second, avoid investing money you borrowed. Do not use credit cards to invest. Do not take loans to invest. And do not use money meant for important expenses. Third, avoid checking your investments every hour. If you are investing for 10 or 20 years, daily price changes do not matter much. The market will have bad days. It will have bad months. Sometimes it will have bad years. That does not mean your plan is broken. The biggest mistake is panic selling when prices fall. When the market drops, many people sell because they are scared. Then they miss the recovery. Instead, remember why you invested in the first place. You invested for the long term. You invested because businesses grow over time. You invested because you wanted your money to work for you. A market drop can feel uncomfortable, but it is a normal part of investing. Now, let's make this very practical. Here is a simple beginner plan. First, save a small emergency fund. Second, pay off high-interest debt, especially credit card debt. Third, open one investing account. Fourth, choose one broad, low-cost index fund or ETF. Fifth, set up automatic investments. Sixth, increase your contribution whenever your income increases. That is it. You do not need 20 different stocks. You do not need to become a financial expert overnight. You do not need to predict the market. You just need to be consistent. Imagine two people. Person 1 waits for the perfect time to invest. They spend years watching videos, reading news, and worrying about market crashes. But they never begin. Person 2 starts with $50 per month. They choose a simple broad market fund. They automate their investments. They keep going even when the market is boring. 10 years later, person 2 is far ahead. Not because they found a secret, but because they started. Investing is not about being perfect. It is about being patient. The easiest way to start investing is to make it boring. Make it automatic, make it simple, and make it long-term. Start with an amount you can afford. Choose a diversified, low-cost investment. Set up automatic contributions. Then give your money time. Your future self will not care whether you started with $10 or $100. Your future self will care that you started at all. Remember, this video is for educational purposes and not personal financial advice. Before investing, do your own research and consider speaking with a qualified financial professional if you need personal guidance. The easiest way to start investing is simple. Start small, stay consistent, and let time do the hard work.